Welcome to the Fintech One-on-One podcast. This is Peter Renton, co-founder of Fintech Nexus and now the CEO of the fintech consulting company Renton & Co. I've been doing this show since 2013, which makes this the longest running one-on-one interview show in all of fintech. Thank you so much for joining me on this journey. Now let's get on with the show. Today on the show, I'm delighted to welcome Ricardo Pero. He is the CEO and founder of SellersFi, previously known as Sellers Funding. Now, SellersFi is a super interesting company focused on the e-commerce space, or e-commerce merchants to be precise. They provide working capital and a range of different services these days to e-commerce merchants. We obviously dive into all of that. Now, e-commerce, as you can imagine, is dominated by Amazon. SellersFi has a special relationship with Amazon, which we do delve into in some depth. We also talk about underwriting, because the great thing about working with these large e-commerce platforms is they've got a lot of data. They have APIs that make it available, make it really easy to use this data and plug all that into underwriting models to make lending decisions. So we go through that process. We talk about the scale that SellersFi is at today and his vision for the future, and much more. It was a fascinating discussion. Hope you enjoy the show. Welcome to the podcast, Ricardo.
Hey, Peter. Thanks for having me here. It's a pleasure to see you again.
Yes, likewise. The pleasure is all mine. Let's kick it off by giving the listeners a little bit of background about yourself. Give us some of the highlights before you started SellersFi.
So I was born in Brazil. I came to the US in 2000, working for Citibank, working sales and trading, built my career there. Started with FX and rates, all the way to manage sales, a trading desk with covering multi-asset classes. Left Citi in 2007, moved to Merrill Lynch. A little crisis hit the financial markets in 2008,
Right.
and then I was kind of rescued by JP Morgan, where I spent the last 8 years of my career working in New York for a big financial institution. Then in 2016, I left. I wanted to build something new for myself, something that I could leverage my experience, but also learn something new. And that's when SellersFi came. First the concept, and then we launched the company in 2017.
Okay. So let's dive into that process a little bit. You were working on Wall Street. You decided you wanted to build something. How did you settle on the idea for SellersFi?
For 6 months or so, I did a lot of research and in different segments, look at lending, I look at RegTech and wealth tech. And one day I got a phone call from a friend who was selling wholesale, moved his business to Amazon, and his sales quadrupled in 6 months. He called me and said, look, I'm looking for a new source of, a reliable source of working capital, because if I keep up with this growth, I won't be able to finance all that with his own capital.
Mm-hmm.
And he said, I need to reorganize my finances. I need to have a better understanding of all the fees that Amazon charges me from advertising, logistics, and commissions and so on. In my mind, I thought, okay, this must be a piece of cake, right? E-commerce, multi-billion-dollar industry, Amazon. Who doesn't know Amazon? And I went to talk to first my former employers, like Citi, Bank of America, JP Morgan, Chase. And to my surprise, they had no clue, because most banks, they lend to SMEs under a predefined box.
Mm-hmm.
And you rely on personal guarantees, you rely on physical assets as collateral, like receivables, for example. And then e-commerce changed the whole thing, the whole dynamics, because with Amazon, you don't need a warehouse. You can have all your fulfillment done by Amazon. I learned later, in time, that most of our clients, they start their business financing themselves based on their own personal available credit lines. So you have like a credit card that you're purchasing goods, and once you start scaling to a point where you need like serious money, your personal credit score is worthless because you're already maxing out
Right.
your available lines. And so a FICO score or like a Vantage score, it's not a good indication of your credit worthiness. And banks don't get that. Now they are learning after 7 years in the making. Some banks have been doing great work on that space, but still there is a lot of room for improvement and understanding of the sector. And then when you look at e-commerce in general, after figuring out a solution for my friend, I did some more digging into SME lending. And one of the biggest challenges for small business lending is how reliable the data is. Because if you go to a QuickBooks, if you go to a Xero, if you go to any accounting software, you can go prepare a P&L, prepare a balance sheet, and share with a lender. And 30 seconds later, you can unsave all the work and change all the data.
Right.
It's not standardized, it's not reliable. And with the marketplace, it is actually something quite interesting because once you have your API connected, you have access to standardized data that cannot be corrupted by the applicant. The data comes straight from the marketplace or the e-commerce platform to us. And that's a big advantage because you can create a credit model based on that data, based on the KPIs that you know that you're going to upload from the platform. And that was a big plus for us. So when I started the business, the first 3 hires were like data scientists.
Right.
The idea was to build a credit model that we could rely mostly on the e-commerce data, and it was less about personal credit scores or bank account information and more about e-commerce data. And that's what we did.
Well, I do want to dig into the underwriting in a little bit, but before I do, let's just talk about how you've kind of grown the business. You obviously you started just with Amazon, right? Just funding Amazon businesses. How have you evolved over, the last 7-8 years since you started?
One thing that I realized was we wanted to work with, on a relative basis, larger business, more well-structured business. And I soon realized it was about client lifecycle. Most of our clients, they start with Amazon, but once they start building their presence and they start building a presence for their brand, at some point they will look to diversify into other channels. You look at Walmart now, is probably the fastest growing marketplace in the US. You have Shopify, you have other omni-channel platforms where you can leverage and start selling outside of Amazon, right? And my idea was, okay, if I rely only on the Amazon data, I'm going to be leaving out a lot of data and a lot of sales from other platforms, especially for these merchants that are like white label guys that are building their presence elsewhere. The other thing was a way for us to differentiate ourselves from Amazon Lending. Back then, Amazon Lending was our biggest competitor,
right?
But they only had access to the Amazon data. They had no clue of Shopify data or Walmart data, eBay data. So the idea was, I'm gonna create value to my customers by connecting to multiple platforms. I'm creating value to my shareholders because we have more data to perform a better underwriting. And that's how we did it. So that was, I would say, the first wave of innovation that we established here in the company. Nowadays we have connectivity with about 10 platforms.
Okay. Interesting. And so what are the suite of products you offer exactly today? Can you just run through, obviously you have like a working capital line of credit, is it, or is it a loan? Well,
Yeah.
tell us about what you have.
Yeah, we have a suite of working capital solutions from lines of credit to term loans. We have daily payout solutions to Amazon sellers, maybe soon in the future, extending this to other marketplaces. So it's less of a lending solution and more of a payment solution in a sense. We are automating, looking at previous day sales, discounting any fees and potential write-offs that the client has, and we advancing that money on a daily basis, resetting the clock on a bi-weekly basis or monthly basis, depending on the cycle that the marketplace pays the merchant. We offer a digital wallet and a digital bank account. We have established that digital bank account in partnership with Citi to offer our clients a banking platform so they can receive marketplace payouts in dollars, CAD, euros, pounds. Citi has a global network of digital accounts that we can leverage. And the digital wallet, in a way, addresses two things. First, our ability to automate and scale in a very structured way where we can mitigate our operational risk. That was the initial goal when we established the digital wallet, and kind of you aim for one thing and you end up hitting another thing. We soon realized that about, I don't remember the source, but I think it was Marketplace Post that put something together, but about 50% of merchants selling in the US are foreigners. And in a way, when we offer the digital wallet, we are offering a solution to these foreign sellers selling in the US. They can receive the marketplace payout and close the FX, repatriating the proceeds from their sales back to their home base country. And also they can pay their suppliers in different currencies using our platform. And this is all integrated with our working capital solution.
Interesting. So it's mostly the international people that are using this. Like, do you find is there any advantage for an American business using this wallet, or is it really for the international vendors?
The US business, they can benefit because they have an integrated working capital solution.
Ah, gotcha.
They will probably be paying less in FX rates with us than they pay with their bank or other provider. We can bundle the working capital solution with the FX and be extremely competitive there.
Right. Okay. So I want to dig into the underwriting here because I think it's interesting. You mentioned that a lot of businesses, they're on Amazon, they might be on eBay, they might be on Shopify. Tell us a little bit about how you gather up the data in order to make an underwriting decision.
When someone comes to us to apply for a business loan or line of credit, they connect their store. It can be like multiple connections, it can be Amazon, eBay, Walmart. They can connect with Shopify and so on. So they connect all the platforms that they work with. The moment that they connect, we upload the data and we consolidate the data. So we assign a risk scoring per marketplace, and then we consolidate that. That risk scoring points to indicative terms, meaning amount, maximum term, and indicative pricing. One of the biggest concerns I had was how I could balance the usage of technology, and in this case, AI, because it's a machine learning model that suggests the pricing, without losing the aspect of the human interaction. Most of our competitors, they have, and you see that left and right when you have, like, you see airlines, you see banks, you see everywhere you go, the first interaction is with a chat box, like you're talking to a machine. But here, when we started assigning a credit, a success manager to that relationship. So the person knows that there is someone else looking at their application, and there is a phone call away. If you look at our ratings on and comments from clients on Trustpilot and so on, there's a lot of mentioning about our sales team and the support that the sales team provides. So the underwriting leverages a lot of the marketplace data and historical payouts that the marketplace has to offer. But we also look at we have integrations with credit bureaus like Experian, TransUnion, and so on to check additional data from the market from the owner and from the business. We have a partnership with Experian where we provide data of all the good payers. In a way, we are helping the company to create a better credit scoring for themselves, detaching the company's credit score with the owner's credit score. So the company will be down the road able to secure additional funding, additional financial services without having to rely on the owner's personal credit score.
Right. So you haven't mentioned accounting data. Are you pulling like the QuickBooks, NetSuite, Zero data in the underwriting process as well? And are you doing that in an automated fashion?
We require that for larger applications, not for smaller ones. The one thing that we require is the connectivity with bank account.
Right.
So we cross-check the information from the bank account with the information from the marketplace.
Are you looking at the expense side then? Because obviously there's going to be different companies that might have very similar, volume on Amazon or eBay or whatever, but run their business very, very differently. And one's a good credit risk and one is not. I mean, how are you doing that?
Some of the information we can get from financials, and we have, again, depending on the size of the loan, we have a call with the applicant to understand better their terms with their suppliers and so on. So we can model and offer a solution for them that actually is suitable for their cash flow needs. So if they need, the lead time is 90 days from purchase order to sale, we can offer them a term loan with a 90 days interest only with no principal amortization during that process. Because it's even an educational process. The new applicants, they are getting to know us and getting to know the products and solutions that we offer. So in order to get that better understanding and offer the right solution, I mean, there's nothing more important than having a dialogue, right?
Right.
We can make estimates on cost of goods sold and terms on averages, but depending on the size of the transaction, I mean, a phone call or a video call in this case is more valuable than anything else.
What causes you to decline a loan? What, maybe you could tell us some sense of how, like, what is the approval rate?
I would say reasons that makes us decline applications, probably low margins that don't support a larger facility when you don't have enough free cash flow to support additional debt. That's probably the number one.
Right.
Declining sales also play a big role. I mean, we'd like to see at least stable business. Sometimes there are reasons to see declining sales, and we make exceptions, but at least stable to growing business. We prefer to work with those. I mean, we have over 10,000 stores connected, so we know how e-commerce in general is performing. And
right.
These stores combined, they represent about 1% of e-commerce in the US already.
Wow.
So it's a large number. I would say, and the third aspect is any relationship with other lenders that puts us in a junior position against other lenders. If the company is already too leveraged, and we are too junior in the capital stack, that will put the applicant in disadvantage for approvals.
Okay. Okay, so I want to talk about the Amazon lending program that you actually mentioned before. They discontinued this program. I imagine that was a good thing for you guys. I mean, what was the impact and how have you kind of taken advantage of that?
We secure a direct relationship with Amazon now, where we are actually pre-qualifying merchants in partnership with Amazon and offering our solutions inside the Amazon dashboard, sellers in Seller Central. So having this enterprise relationship with Amazon, of course, we gain a lot in terms of ability to have an open dialogue with them, data sharing, and so on. So that was a major improvement. Remember, like the first 6 years, 7 years in the making, the company got the APIs. We got the APIs driven by customer demand. Right now, we have a direct dialogue with the marketplace. In this case, Amazon. So Amazon is discontinuing their offerings, and we are stepping up. I think that they are doing a fantastic job in terms of managing our relationship with them, managing customers' expectations on that transition from an Amazon lending program to a broader range of financial solutions provided by multiple partners, and I think was a very smart move on their way.
I read, I think that you're allowed to bump up your credit lines, right? You now, I think, was it $10 million is the max that as part of that deal?
Yeah, we have worked with different providers. So the idea is to increase the maximum credit lines available per merchant. We're working with no, it's a broad range. I can tell you, like we are looking for merchants that sell as low as, I don't know, 100,000 a year to the other day we had someone that was selling $400 million
Right.
a year and connected to our platform. So it's a broad range of merchants connecting to our platform. It's a broad range of loans size that we can offer. But the combination of better data and the direct relationship with Amazon also brings some mitigating factors in our underwriting process, right? When merchants come our way, we are talking about merchants that are pre-qualified based on parameters that are mutually agreed between us and Amazon. So it helps us, brings a new layer of comfort in our underwriting process.
Can you give us some sense of the scale you guys are at today? I mean, and how much is Amazon kind of dominating your business?
Last time I checked, we were aiming to do like $750 million this year in terms of loan disbursement.
Mm-hmm.
Of course, we need to rely on some standard variation based on credit cycle.
Right.
And our approval process has been impacted by the recent credit cycle, negative credit cycle, had some bad news from some of our competitors. We're taking a more conservative approach, but I would say that we will do probably close to $1 billion next year in terms of loan originations. Amazon represents a big chunk of it. And like I said, the other day I was in a board meeting, we were talking about the Amazon concentration. I said, well, e-commerce in the US is 50% Amazon. How I cannot be concentrated, right?
Yes, there is that.
Yeah, there's like a natural concentration that you cannot escape from that.
Right, and Amazon's not in any danger of going out of business anytime soon. So.
No, I don't. I'm not concerned about that.
Right. Love to get your sense because you've got a unique perspective here on the state of the e-commerce merchant because you've got thousands and thousands of merchants. Are they gearing up for a downturn or how? Like, because Amazon continues to grow, their numbers keep growing faster than the economy overall. So, is that reflected in the merchants that you have on your platform?
I think that e-commerce growth will naturally outpace retail growth. Amazon will benefit and is the leader there. We've been witnessing a softer consumer demand,
Mm-hmm.
softer sales, but resilient. I'm not talking about declining sales, but a softer growth this year.
Right.
I've seen, and I'm talking to other peers and credit funds and banks. I mean, in general, you see an increasing concern about delinquencies in the consumer side. And I mean, we are in a very intense and delicate year with elections coming in and a lot of talk now about rate cuts, but should we see rate cuts before the election, after the election, and so on. So it's been a very challenging first half in terms of approval rates and seeing some softer sales. But I would say I want to believe, and I really believe that we are kind of at the end of this bad credit cycle that started when rates start to spike, like
Okay.
the Fed.
I hope you're right. So last question then. You've built yourself a great platform here, but what's your vision for SellersFi? Where are you taking this?
When I started business 7 years ago, Cabbage was one of my benchmarks.
Right.
And Cabbage started with eBay,
Yep.
and it was a very similar
Mm-hmm.
story, right? And at some point, they look at the market and said, okay, I'm going to diversify into other industries. And they did, and then COVID hit, they got acquired by American Express. When I look at our business, and I faced that challenge many, many times, I said, okay, should I diversify into other industries or should I stick with e-commerce? And our idea was, and my conviction is, I'm going to stick with e-commerce. I'm going to expand the product offering, other financial services, not necessarily working capital solutions, but payments or business intelligence or insurance, banking. So the idea is to diversify within the product offering within the same industry.
Mm-hmm.
Look, I wouldn't be surprised if 3 years down the road we become like a neobank with a full list of financial services and banking products dedicated to e-commerce sellers.
Okay, well, we'll have to leave it there, Ricardo. Really fascinating chatting with you. Congratulations on your success and best of luck in the future.
Thank you. Thanks for having me here.
Well, I hope you enjoyed the show. Thank you so much for listening. Please go ahead and give the show a review on the podcast platform of your choice and go tell your friends and colleagues about it. Anyway, on that note, I will sign off. I very much appreciate you listening, and I'll catch you next time. Bye.